deal person. Here she is today, Jodi. So we're gonna keep it interactive, but I will say we'll keep the questions to the end as opposed to in between, only because we have the hour today. We're gonna start by just a general question and a chance for our panelists to talk a little bit about their firms and what they do, but generally speak about, you know, what activities are you involved with today? What kind of deals are you seeing? What kind of deals are you looking for? And we'll just start with that, more of a general introduction, and then we'll get into some specifics. So I'll just start on this end and work my way to Sima. If you'd like to start with the mic, and I think that'll project out.
Well, hello, everyone. I am delighted to be here. This is my first FEI meeting. I watched on Zoom this morning in the comfort of my pajamas, I hate to say. But it's great to be here with you guys. I have been in the deal business for 25 years. We just celebrated our 25-year anniversary at Aethlon. And I have the battle scars to show for it. By the way, Aethlon is the Greek word for prize of the contest, as in decathlon or triathlon. And it is our mission to get business owners like Nate the prize at the end of their entrepreneurial journey. Very busy year for all of us in the deal business. We recently sold 2 companies, Navigate, which Nate was the CEO of. We sold them to a New York Stock Exchange company called Radiant Logistics, and that was a fun journey. We'll get into that later. And we sold Jasper Engineering, a Minnesota-based company that is a manufacturer's rep and distributor of industrial products, pumps, valves, instrumentation. And both Jasper and Navigate had the attributes of companies that we represent. Number 1, established businesses. Navigate over 50 years, Jasper and the family for 65 years. All of the companies like Navigate and Jasper that we represent have growing revenues and growing profitability. And lastly, they need to have a diverse customer base, not be beholden to one large customer, and serve a variety of industries. And just to wrap up, we represent companies in a wide range of industries, but we do a lot in manufacturing, technology, consumer products, and in Nate's industry, transportation and logistics.
I think we'll skip over to Beth and come back to Nate, because Nate's got a long story for us.
Okay, great. Good morning, everybody. So as Jay said, I'm Beth Lilly, and I'm the Chief Investment Officer at the Pohlad companies. So just, you know, of course, the Pohlads are most well known for the Minnesota Twins, but they have a bunch of operating businesses, United Properties, Northmark Capital, Par Systems, and then Carousel Motor Group. So if anybody's in the market for a new car, we just opened up the Ferrari dealership down 394. So we're happy to take your order when you leave here. And then they have the Minnesota Twins, as well as they have Minnesota United and the St. Paul Saints, and River Road Entertainment, which is the movie production studio that's run by Bill Pohlad. So those are the operating businesses, and then I run the investment team, and so we've got a portfolio of all the way from very liquid instruments, cash, fixed income, and we run a liquidity pool for the organization, and then we have another portfolio we call the growth portfolio, which is really permanent capital that we run for the family, and that is private equity funds, public equities, and then we also have a private equity portfolio. So we have a portfolio of 17 private companies in that it's our own, in essence, private equity fund. And you know, when the pandemic hit, we had several companies in that portfolio that were in process of talking to strategics, and then the pandemic hit and everything shut down. And last year we sold 5 companies out of that portfolio. The most notable one is a local one. It really fits the type of the profile of the company we're looking to invest in, which is Yardbird. I don't know how many people in this room have Yardbird furniture, but that deal came to us proprietary. There were no bankers involved, and it was just a family-run business that was looking for capital to grow. And so we made an investment. And the investment was going along really well, and then the pandemic hit, and then their revenues went like this. And as we were continuing down the path of helping them with their growth strategy, lo and behold, Best Buy came knocking out of nowhere. Just absolutely out of nowhere. And I mean, they were bound and determined to stay independent, but Best Buy made an offer that, you know, it was very hard to refuse, in the sense of capital to grow, you know, and with shipping and containers and everything being such an issue, shipping costs had tripled, and it was just really easy to figure out how the yardboard footprint would fit into the Best Buy model. And so they bought Yardbird last year. So that's the type of company that we look for, though, to invest in, which is, you know, great management team. We want to be minority owners. There's, you know, two parts to Pohlad companies. There's the operating businesses where we're a majority owner, but then what we do is minority investments, minority ownership, management stays, interesting business model, unique model, growing revenues, and EBITDA positive. So anyway, so that's who we are.
Good morning. Well, it's my first time here. Thank you for inviting me. I am a shareholder at Moss and Barnett. Obviously, I'm a lawyer and we're a law firm. I've been practicing law now, I just said this morning, for 25 years. I almost threw up in my mouth when I said that. The reality is we really, as a law firm, do any type of deal work. You know, we would take any kind of structure or anything that comes in and we can handle. We have the ability to handle that. For me personally, some of the deal work that we worked on last year that were some of the bigger deals were multi-generational transactions where family-owned companies for multiple generations had decided to sell out. There was a lot of easy money out there, high multiples, and a lot of private equity for those types of transactions. So families decided that it was time. Some of the older generation was ready to retire, and they didn't have anyone behind them who really wanted to take over the business. I also worked on a lot of equity infusion deals. And so a couple different types. One is JV type transaction where you have an entity like United Properties, who I do work for. They like to do deals and develop them and bring in money and hold an interest in them. And they go out and find a partner to come in and infuse equity, and we'll form a separate joint venture deal that United Property holds as a membership interest, which is usually how we set them up as LLCs. And then we bring in other equity investors into the deals. US Internet, a good client of mine, they brought in equity and also debt this year. So they sold a minority stake to a company and then took in a bunch of debt. So we worked on that. That was a really fun transaction. In terms of industry types, really, I mean, what I've even touched on, and just talking to a couple of partners, even in the last year, you know, we worked on real estate, fiber infrastructure, energy. I've got an entity now that I represent that's a trucking company that's selling, distribution industry, manufacturing, advertising, and media, financial services. We just run the full gamut really on what we have the ability to do, and it's fun. I would say that 2021 was a very fortunate year for our firm. We did very well, especially in the corporate group, and I don't think that anybody mid 2020 would have predicted that. So we're happy.
That's great. Nate, you have a great experience, and the search fund industry is very interesting. That is really coming out. Maybe you can talk about your experience, search fund versus a fund sponsor. And now that you've gone full cycle, can you tell us what you're going to do next?
Yeah, well, Jay, thanks for having me. Maybe I can give my intro first, just to introduce people to who I am. My name is Nathan Day. Most recently was the CEO and chairman of Navigate Inc., which we sold using Aethlon last year. I've been in the M&A business since 2005, really started on Wall Street, bulge bracket investment banking, moved to a boutique in Chicago, specialized in transportation and logistics M&A for quite a while, and then decided to go out and raised my own fund in 2016, went around the country to family offices, high net worth individuals, folks that are fund of funds that invest in search funds. I was able to get a capital base and then go out and canvass the country to buy a business. And so bought Navigate in 2018 and was a really successful exit last year, thanks to Sima and everybody on the team. So really excited about that. So I have seen kind of everything from all angles. To hit your question real quick, I mean, the difference between a fund sponsor and a search fund, a handful of things. I'll kind of set the stage. Those search funds as an asset class have been around since the early 80s. And so it's not new. It's just kind of catching fire a little bit. It's become a little bit more popular. And so the key differentiators, there's a handful, but number one is that you usually have some seed capital, right? So you're not just doing this on your own and then going to look for capital later after you've identified a deal or you have something under LOI. You actually have committed capital that is sort of in your LP base that you can work with. Typically, those are entrepreneurs or other people that have grown and built businesses that you can call on for expertise, both in the deal phase when you're doing diligence, but then also you can call on them for your board when you're trying to assemble the board or getting your syndicate ready to buy a deal. The other thing is that unlike a fund of sponsor where there's really just kind of an endless number of portfolio companies that you may have, the model is geared towards inserting yourself as management. And so it's a one of one. So you have a fairly binary outcome in terms of, you don't have that shared risk of a sort of a basket of assets. But the thesis being that if you're there every single day, you're the one actually pulling the levers, you can get a better return. And so historically, since the early 80s, the search funds as an asset class have returned a 32% IRR, which is phenomenal. Compare that to kind of 10.5 for PE over that same period of time. And so what these investors have found is that when you have a highly motivated, highly engaged management team and somebody that's out there looking for good assets, you solve kind of half the private equity equation, right? So you already have people that are sourcing the deals they're interested and they're highly motivated based on the alignment of incentives that they're going to get the deal done. And so that's kind of the genesis of that. I was able to rely on sort of past networking, and that's how I got into the Navigate fold. While I was doing my search fund, I had about 5 deals under LOI. So again, this is kind of going back to about 2017, 2018 timeframe. You look for places where you can win, where you have competitive advantage. I knew the transportation and logistics space pretty well, having covered it on the banking side. And I had actually met Joe Pelletier, who's the president of Navigate, back kind of in the 2012 timeframe, I think it was, when we were looking at bolt-on acquisitions for other clients. And so we were able to get in there and kind of rekindle that relationship. Joe's still there, kind of post-close with our deal, which is great, tremendous stability through the investment period. But what we were able to do is we bought Navigate in 2018, doing about 40 million of top line revenue. And last year we closed in on 110 million. And so in 3 years, we were able to completely recut the organization, do a lot of things to align incentives, to move from a branch model to a more product focused business model. And it allowed us to just get tremendous growth. And supply chain's been a very turbulent space, as you all know. And we were in the right place, the right time, had the right tailwinds. And like to think we maybe did a few good things along the way too. So yeah, that's the story.
Great. Just to tack on to the search fund industry, my understanding is it started on the East and West Coast. Stanford was a big player and the Ivy League's 1 or 2 schools, if I recall. And then it's kind of made its way through the country at this point. I'm interested to know how much money are investors willing to put up to do the search, right? So typically they give you 2 to 3 years to do the search.
Yeah, that's right. So yeah, the gravitational pulls are typically Harvard and Stanford, although there are a lot of other schools. I'm a Booth guy, so coming out of Chicago and Kellogg both have pretty strong performing searchers these days. And so it's a growing asset class. People are really interested in it. I'd say at any given moment, you have to think about it in vintages. Typically it follows the business school cycle of graduation. So every year there's another cohort of searchers that are coming into the market. A lot of liquidity out there for these types of assets, because what it does is it offers access to lower middle market deals that a lot of these folks don't typically have. It's not quite sophisticated enough for private equity, but you can come in there and insert management and get the returns that you really need. And so the way the model is designed is that usually in your second year of business school, you start courting the investors. At that point, they'll give you some seed capital. That's usually in the $400,000 range, something like that. So you can take a draw. You have enough for your overhead expenses while you're traveling, while you're looking for a company to buy. Typically, people will use that for a CRM or just some mail merge tools, things that you can get your marketing message out. And then the rest of it's mostly travel. And you have to go out and pitch yourself as to why you're the best alternative. And if somebody's thinking of selling, why not strategic? Why not more professional private equity? Why not a bolt-on acquisition for a portfolio company? And you really just have to make your story heard and make sure that this is the best outcome for the current investors. And I was able to do that, and I think it's a phenomenal model for a lot of people that have that type of energy and want to do it. It's herding cats. I mean, I had 27 LPs, so it's a lot to handle, but we got it done.
I'm going to say something because this is supposed to be interactive, and I'm going to say something that's going to be very unpopular. But as a banker, when you are choosing between potential buyers and you have a fundless sponsor and you have a publicly traded company that has $500 million on their balance sheet, you're going to pay attention to the publicly traded company. So the fundless sponsor really has a more challenging job.
Well, I'll add one thing to that too, is nothing against fundless sponsors necessarily, but if you're signing a deal under LOI and then you have to go then shop it to another private equity firm, that seller doesn't know with very high confidence who the shareholders are ultimately going to be, right? So that's a tough thing.
Hey, do you see, for example, like we've had examples earlier this morning, somebody sold their business. Are they able, not necessarily to come out of school and be a search funder, but can they be a search funder after they've sold the deal as a previous owner?
Yeah, 100%. I mean, there's been all kinds of folks that have done it, late stage career people without an MBA, people that are 4 or 5 years into their career. So it really doesn't, it's not a one size fits all model. Stanford puts out a primer every 2 years. So the new one isn't ready for 2022, but if you go back to 2021, you can see all the statistics on how the asset has performed as an asset class. What's the sort of degree of outcomes, right? So roughly 30% of searchers don't close a deal, 70% do, and then within that, there's sort of a different distribution of outcomes, right? So some people have tremendously outsized returns, and other people do okay, and some fail, and that's okay, right? I think that as a search fund investor, you look at this, it's private equity, lower middle market private equity, but it's also very VC-like because of the way the search fund investors approach it. I mean, they're looking at backing 10, 20 individuals in their search every year.
I'm just going to add one last thing, and that you, Nate, are going to have a much easier time because you just returned your investors 3 times their money. And so when you go out seeking capital for your next deal, you're going to do it in 60 days.
Are you doing that anytime soon?
Maybe, yeah, stay tuned. I'm super passionate about the asset class. I really love the entrepreneurial nature of it. I love the mentorship angle because, it's, beyond the sort of personal capital experience that it's allowed me to kind of grow. Just what you can learn as an executive. And like Sima, I was a banker for a really long time, and I had done principal investing at a private equity firm. I'd done VC stuff, so I'd kind of seen it from all angles. But until you're in the trenches and you're operating, I mean, it's a completely different animal. And we had a couple of really challenging things that happened to us in 2019. The trade war really was a challenging thing. 2020 pandemic, right? So we had some very, very turbulent waters that we had to navigate. And there's also just the challenges of running a business already, right? I mean, we had a 52-year-old company, and you're trying to take this institutional inertia and shift it and pivot it and trying to bring new things to that ecosystem. It's a challenge in and of itself. And so I think we have a lot to offer for aspiring entrepreneurs that like this model because, we can teach them how to handle those things.
Perhaps FBI will have to bring you back for another half-day panel on that. Thank you. I want to just open it up to the entire group and talk a little bit about your own experiences in the M&A market from, let's say, 20, when the pandemic hit, to today, and maybe what you've seen in the last couple of years during that time, and how it's affected your own M&A experience and deal flow. I'm going to start on the far end. Thank you, Jodi.
In terms of deal flow, we just were bombarded last year, right? Which is interesting because, like I said, we wouldn't have predicted it. But from the legal side, what are things that we maybe saw that were different or were negotiated more intensely than they used to be? And some of them, from our perspective, were contingent considerations. Like, for example, when we're talking about earnouts. So oftentimes now what we're seeing is on the sell side, the seller's not getting all the money up front. There's earnouts, whether or not they're contingent or not. So sellers hoping that they're not contingent, but waiting a little bit for that money. Secondary is contingent, where there are certain measurements that have to be met in order for those payouts to occur. And there may be a sliding scale in how much that gets paid out depending upon how the company performs or not. And where you're really seeing them are industries or companies where they may run into labor shortages, or there's a risk of that, or supply chain shortages. So the buyer's unsure necessarily. It looks like it's a good company on the books, and we have projected earnings, but there are these unknowns out there and that most companies are dealing with. So the buyer's not wanting to put all the money on the table. So those are some things that make the seller uncomfortable, obviously. And what also makes the seller uncomfortable is they're out of the deal once the deal closed. So the buyer's wanting them to wait and take cash that's contingent on certain things being met, but the seller's not there to be able to run the business. So they have to get to a point where they can trust that the buyer has the ability to meet the measures that they're going to agree upon, or that they're willing to agree upon, and take the risk, and how much money are they going to risk on that. The other thing that I really see is control versus majority versus minority interest holders. And there's two different types of deals where that can flip-flop. On the one hand, you see deals where they're joint ventures and the minority holder has all the expertise. So they're the ones that are going to go in and run it, and you've just got equity coming in, and the equity is the majority owner. Well, the minority owner is actually going to run the business from day to day, and they're going to have a lot of autonomy and a lot of control. And what we would negotiate in those deals is what major decisions would there be that the major equity holder gets final input on. So there's a lot of negotiation around that. On the flip side of it, we see deals where you've got a minority interest holder coming in terms of shareholder interest, but they're putting in a lot of debt. So in terms of the corporate formality structure, they're a minority interest holder, but they want control, even though they're a minority interest holder, because they got a lot of money in there. So on the day-to-day, again, you'll see that the majority interest holder will run, but there's heavily negotiated major decisions where the minority interest holder / debt holder has the final say. And then the negotiation is really, well, when do those run out? How long does that minority interest holder get a stake in these decisions? When does it run out? So those are heavily negotiated. Reps and warranties insurance, I heard somebody ask about that in the last session. I mean, that's something that sellers are really looking into now, buyers are accepting. Really, when it's about 100 million or more, you're pretty successful as a seller being able to get the insurance and the rep and warranty insurance, and hopefully with some minimum carve-outs, having no other liability but for what that insurance provides. Certainly you can't get that for tax and environmental. On deals below that, we have had a bunch of success in negotiating baskets so that there's not just unfettered liability. There's some limitations, whether or not you have to put that up in escrow is another thing to negotiate over. Oftentimes, the companies that I've been working with, we haven't had to put it up in escrow, but there certainly is. That's because the seller has enough money there that the buyer's not too concerned that the money's going to go away. Sandbagging provisions, as a seller, you don't want them. As a buyer, you may want them, which is a buyer sells them reps and warranties. Even if I know that one of those reps and warranties is false and I close, I can still come after you for breach of that warranty. Seller doesn't want that. So many times what we try to do on the seller side and that is just have the document silent on it, because Minnesota is pretty anti-sandbagging. So we try and leave it at that. One thing we were going to talk about was the Osha testing mandate. So when you're looking at deals and COVID issues, part of the due diligence was just looking into how is the company handling that? Are they meeting the requirements? Are they meeting the new OSHA standards? Do they have their plans in place? Are they ready to go? And then was it a week ago, 2 weeks ago, the Supreme Court put a pretty heavy kink into that. And then I read just yesterday that the Biden administration has basically withdrawn them now. So for employers and for deals, that's helpful, that we don't have to worry about that anymore.
I would say, it's interesting, if we look at it a big picture perspective, with the decline in interest rates and what occurred with the Fed and the government and everything, there was a tremendous amount of capital that flooded into the markets. And so what we're seeing was deal flow shut down and everybody was waiting for opportunities. And then the Fed flooded the market. And so now what we see is really, really high valuations. People not diligencing deals. I mean, it's unbelievable how quickly deals are closing and transactions are getting done, and we may go in and start to do our due diligence, and then all of a sudden a company will do an exclusive with another company, and then they end up paying a very high price for these assets. So we see valuations really, really high right now. And we're hopeful that the correction in the equity markets are going to bring valuation multiples down and expectations down. So, things were high. The market was relatively fairly valued when the pandemic hit, and now they were over. I think the markets have been overvalued by virtue of the Fed and all these private equity funds that have raised all these billion-dollar funds, and there's so much liquidity and they have to put the money to work, otherwise they can't earn their fees. And so, it's this interesting dynamic that's occurring. And, the good news is when you work for a family, there's no urgency to put capital to work. So you can be patient and wait. And so I would say, we're waiting for opportunities, but there's a lot of ridiculous valuations out there right now. And, what is amazing to me is that there's all these companies that are these private equity firms that are doing these acquisitions, and then they're paying these high prices and they're building out these platforms, and they justify it by saying, well, we're going to do tuck-in acquisitions and then bring the multiple down. So it's all about returns, and we're not going to know how this all boils out for the next couple of years, because these private equity firms don't have to, it's all these 3 and 5 and 7 year funds. But I have a hard time to believe that the returns that the funds have generated in the past are going to continue based on the prices that are being paid today. So hopefully the correction in the public markets are going to bring expectations down, as we see valuations much too high. And that's the biggest change, and all the capital that's trying to find a home.
So like 2019, all of us in the deal business were on this high-speed train. And then, as Beth said, 2020 Q2, conductor slams on the brakes and deal business stops. But in 2021, as Beth said, so much PE money out there that they have to invest, otherwise send it back to the LPs. And publicly traded companies looking to grow can't do it organically. Let me buy a company. And I'll give the example of our client, Jasper Engineering. We had 11 LOIs, and they ranged from a family office in Arkansas to a PE fund to a strategic. And instead of flying to these meetings, we chose 4 out of the 11 to meet with over Zoom instead of a big conference room table. It was very efficient. our client could get a very good idea if the chemistry was right and whether they were going to be good stewards of the business. And I found it very efficient, very efficient. Just in terms of the rep and warranty insurance, this has become de rigueur right now. And the buyer of Nate's company, Radiant Logistics, even though they were a very active acquirer, they had bought like 12, 15 companies over the last 10 years. This was the first time they bought rep and warranty insurance. And we insisted on it. And this also alters the whole due diligence because in addition to the buyer doing their own due diligence, the insurer who's on the line is going to do even more. And there was a race for us to get our deal done by the end of the year. And a lot of the insurers, accounting firms, law firms were all backed up. And the rep and warranty insurers said, like, I can't get this to this until January. And so it took the big East Coast white shoe law firm to put pressure on the insurer to say, get this done in December if you want to see more business from us. So little anecdote there.
That's great. Good story. Good story. I guess we're going to shift over to Beth on this one. Talk a little bit about private investment companies, the family office, and maybe just, you know, what you've seen when you started with the Pohlads, what you're seeing now, and where you think that may head.
So I've been with the Pohlads for about 3 years, and I would say, you know, what's interesting is that it's very similar to the comments that I made earlier, which was there was a progression to deals getting done, and there was a patience, and there was a cadence, and a lot of family offices club up with each other. So, you know, for example, the Carlson family, they have a private equity firm now, the CPC Capital Partners. So they'll go out and they'll club up with other wealthy families. And so that's a very common thing. And what's interesting is that still is occurring, but the biggest change is deals are getting done a lot faster and families are more willing to part with assets. And I'll give you 2 examples of families that we deal with. There's the Dushiswa family out of Chicago. They're not a very well-known family, except they're very involved with the racetrack, Kentucky Derby racetrack. But more importantly, chances are when you drive into your driveway at night and you push your little electric button for your door to go up, and the door goes up and it's Chamberlain, that was owned by the Dushiswa family. They've owned the asset for years and years and years and years. So Blackstone came knocking at their door and they sold their business for $5 billion last year. Medline Industries, which is another family that we deal with, the Hills family, they were a private company for many, 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 many years. And just like the family offices club up, these private equity firms are climbing up because they have so much capital and they also wanted, you know, disseminate the risk. Blackstone, Carlyle, and Hillman and Friedman clubbed up and they bought Medline for $34 billion last year. $34 billion. And it's a health products distribution business. So what we're seeing is family offices are clubbing up, private equity firms are clubbing up, and prices are really high. And so we're really cautious when we see when we see families selling businesses, we're really cautious. And we've sold 5 businesses out of our private equity portfolio. We have another one under LOI that we're about to sell probably, and it's going to be signed today. And it's, you know, we're more of a seller than we are a buyer right now. So that's the biggest.
I didn't realize you were into the private equity space.
Yeah.
As well.
Yeah.
I've always thought family office, but you can see both sides now.
Yes. Yeah.
I just want to add something on the family office front.
Yes.
We often counsel our clients, the sellers, to pay attention to family offices because they're long-term holders.
Right.
They have built businesses. They can help you grow the business,
Right.
and they're not looking for a quick flip.
Right.
Yeah.
Right. The difference is, you know, when we bought Yardbird, we were hoping to own it forever. Honestly, we were hoping that, but we saw at some point there might be an exit. But, you know, we didn't expect to only hold on to it for 2 years. We were hoping honestly to help grow it to the next 7 to 10 years. And these private equity firms say, after 5 years, okay, what's the exit plan here? So So if there's anybody in the audience that knows of any private family businesses that are interested for a minority partner that's very patient, tell them to contact us.
So Nate, have the search funders, have they clubbed up yet?
Yeah, they do, by default almost, right? I mean, so you're never gonna have, one of the beautiful things about the model, it is so entrepreneurial because you get your capital from a wide base, right? And so there's not, it's good and bad, right? I mean, you don't have the one throat to choke, but you also never have anybody that owns a disproportionate amount of the cap table. So it really does make it about the entrepreneur, but it's very much a clubby thing where, you know, if you're in it and you know about it, you find yourselves on multiple boards with the same people, you know, co-investing in deals, referring people back and forth to each other and so on.
So there's a couple alliances. I'm just familiar with the Search Fund Alliance. Are there any other associations that bring them together?
I don't know if there's any other associations. There is the Search Fund Alliance that is a group of search fund investors. It's become more and more institutionalized. So the two largest funds, there's one out of Boston called Pacific Lake, one out of the Bay Area called Anacapa Partners. Those have been, I mean, they're now truly private equity. I mean, they've raised kind of $500 million funds, you know, big money. And yeah, but what's interesting about some of the smaller funds or funds of search funds, it's a really great feeder for other private equity firms, because if you have really great companies and you can help usher them into a new phase of growth, or help at least sort of start turning you know, the flywheel on getting them to be a little bit more professionally managed. If you're a partner at a private equity fund and you've co-invested in a fund of search funds, there's your pipeline, right? So there's a lot of overlap.
That's creative. Well, while the audience thinks of questions, we have 10 to 15 minutes of questions planned here. We'll just have one parting question from the podium, and that is, what is your prediction for the M&A market for the remainder of this year? And if you dare go beyond 1 year, that's up to you, but how about just 22? Who's going to start?
I can start. I think you're going to see a continuation of what we call the gray tsunami. All the business owners, 50s, 60s, 70s, looking to retire and cash out. I think you're going to continue to see more and more money being put into private equity. I'm on a couple of endowment funds, and we are all of a sudden now allocating 10 to 15% to private equity because the returns have been 15 to 18%. So we're going to have another strong year.
A bold prediction.
A strong year, I think, a little bit more of a rationalization for valuations, perhaps. But you know, who knows? There's a ton of liquidity out there. A lot of people chasing the assets. So you know, we will see. But I think Sima's right. We're on the precipice of a tremendous transfer of wealth as the boomer generation kind of moves out, and there's not always a great alternative if you don't have an heir, or if you don't have somebody that's next in line. There's private equity, there's strategics, but sometimes people have a competitive fire and they don't really want to sell to a strategic. It becomes a very personal thing.
Oh, great. You see the shock on my face? So I, like Sima, think that it's going to continue to be strong. I think there's going to be a lot of deal work. We certainly hope there will be a lot of deal work. I also think that there's going to be a continued sell-off of multi-generational businesses, whether it's parts of the business or the whole. You know, I heard it from a couple panel members here, and Pohlads want to put money into those, right? So I think that's going to continue to be strong. I also think that there's going to be a lot of strong growth for those companies who want to put equity infusion into some real strong companies now that just want that to grow. So they're looking at selling minority interests for growth. I do also think, however, that there's going to be supply chain logistic issues and labor issues that are going to continue to surround certain deals, right, in certain companies. And with those, the deal structure and the due diligence is going to have to be adjusted to reflect those types of issues. But otherwise, I think I hope it's going to be a strong year.
I would only add, I think it's going to be a strong year, not like last year. All these funds have raised capital, but interest rates are going to go up. So you're going to see a slowing in activity because of rates going up. Capital is going to be more expensive. I think the other thing we're going to see is returns are going to fall because prices are so high and so many deals are getting done at these ridiculous valuations level that if we look out a couple of years, I just don't think we're going to see the returns from private equity that we've seen in the past. So.
Thank you. We're going to open it up to the audience for questions.
So thanks for your presentations today and your fearless forecasts for the rest of the year. You know, I heard you talk about supply chain and labor economics issues and, you know, interest rates going up. I didn't hear anyone really talk about inflation. And yet we're at a period of higher inflation than many of us have experienced for several years. What are your thoughts about the impact of inflation impacting the near-term M&A markets?
So just to paraphrase, George, we're looking at inflation and what do you think the impact of inflation will have as it relates to the deal market? Ooh, George.
Inflation is transitory, right? That's what I heard.
Yeah.
No, I don't know. Labor's a real concern. I mean, that's the biggest one I would have as an operator and an investor. There's a whole bunch of, I mean, it's the return to work thing is still a real hurdle, right? And it's just the shifting dynamic of that power balance going to the employee base. It's going to cost more to staff your organizations. And that's a real concern.
I don't think inflation, I mean, right, inflation is the enemy of the investor, right? Because it eats at your returns. But I think to the extent that you're investing in businesses that can pass that pricing power, the pricing along, right? I don't think there'll be an issue. And I agree with Nathan. You know, the interesting thing is, I think the real issue for the economy is not inflation. I can't remember a time when I go to do, you know what? I live in St. Paul and I was out in Wayzata. And can't remember. Oh, I was out in Wayzata and I was driving home and my son said, I wanted Jimmy John's. Do you know that Jimmy John's was closed at 5 o'clock on a Friday night?
Yeah.
In Wayzata. That's where I think we're going to have problems. Or the Starbucks is closed at 6 o'clock because they can't staff. That I think, and I keep trying to wrap my head around how that's going to affect our economy. I'm less concerned about inflation. I'm more concerned about Jimmy John's being closed at 5 o'clock on a Friday night. Starbucks needing to be closed because they can't staff. That's the bigger issue. That's a labor issue.
Yeah.
You know, we're at Pohlad's, we're like, okay, what do we need to do to retain our really good employees? How much do we need to raise our salaries so that they don't leave? That's, you know, that's inflation, but that's a labor issue.
Right.
This country has a labor issue. That's what I think is going to be the biggest issue we're going to be facing.
And just to add to what Beth is saying is labor has become a much bigger diligence item in 2022 than it was in 2021. And what kind of contracts do you have with key employees? What kind of non-competes? Who are you categorizing as a 1099 who's really an employee? So bigger diligence item today and going forward.
And just a couple points on that. I think that inflation will maybe impact the returns, but I don't think it's going to necessarily stop the deal flow. And I also think that the labor shortages at some point are going to have an impact on individuals who at some point want to return to the work, because I think they're going to work themselves out of a job. I think that we're going to see companies who can find opportunities if they can develop technology that will eliminate the employees that don't want to come to work. Hopefully that'll self-correct itself in a couple of years, but I do think that these labor shortages, people not wanting to come back to work right now, will have a harsh reality for them in a couple of years.
That's good. Anybody else? More questions?
I'd like to ask a question to Nathan. Nathan, thinking about the panel, when you think about when you acquired the company, when you sold the company, the value add and your trusted advisors like your attorney, like your investment banker, like your investors. Could you just talk about that a little bit about, you know, the importance of them with your journey rather than trying to figure out everything yourself?
Yeah, for sure.
You're going to just repeat that for the people.
Yeah, just the importance of service providers in the journey. You know, Sima to my left here, obviously, our attorneys were out of Chicago. You hire great professionals because that's what they know, right? And if you're the steward of capital, like I was, and the CEO of a company, I mean, you're focused on other things, right? You're focused on your people, you're focused on your clients, you're focused on engineering that return. And so you don't want to be spending a bunch of time spinning your wheels doing other things. And you know, no offense to our purchaser, but, you know, writing legal language in the hotel room, you know, drafting their own documents. I don't think that's an efficient use of time. And so we had phenomenal legal counsel. They did a great job for us. And, you know, Sima did a good job too, as well, you know, going out and canvassing the market, trying to find the right buyer. We had a really unique deal, and we didn't really touch on that here, but part of our thesis was a carve out. We had a SaaS product that was within the business that we were trying to unlock and trying to sort of pivot the business to a best in class SaaS offering in the supply chain space. And part of our thesis initially was to monetize the EBITDA producing engine and then divert that capital into funding almost effectively a Series A, and then dividending out some money back to shareholders. So it wasn't until after we were in diligence and we had gone down the path of signing an LOI that buyer wanted the whole thing. And so it was just a deal we couldn't say no to. But I don't think we would have gotten there without the advisors and without Sima, and a lot of patience, a lot of hand holding.
Thank you. Eric.
A two-part question, but what do you see when you're doing the investments with the clubbing? Are the marriages getting along with the minority situation, with the stress of the pandemic, supply chain, et cetera, inflation? Are the marriages holding together, or are they starting to get a little heated? And the second part of the question is, what do you, when you get into a minority situation, are you directing capital to go to debt, equity, investments in future equipment, assets? What does it look like?
So maybe I can help with that one as we get into clubbing, so to speak. How is that working out? And what are some of the maybe good things, pitfalls? The second thing is, how in the minority situation are we directing the investment? And what are we directing it to?
So on the deals that I've been involved in the minority side, there are those major decisions, right? So there's certain limits on how much the company can spend on certain things without going back and getting approval. But my client was smart in the beginning of the deal because they had projected out, knew what they wanted to use the money for, and negotiated in certain dollar amounts could be spent on the things that they wanted them or needed them spent on when the money came in. So I think as a company that's looking for equity to come in, you really need to know what you need that money for, and you need to negotiate that up front. If you don't, and the person putting equity in negotiates more control later about how that money's spent, that's going to be problematic. And in terms of the couple transactions that I worked on last year that were marriages, so to speak, they're actually working out quite well. You know, there was a lot of work and discussions going in before the deals were made about personalities and whether or not they could work well together, and so far they're holding up very well.
You know, it's interesting. I would say when we club with other family offices, we all, first of all, there's not a competitive piece. It's so interesting. The family office market is not competitive. It's so refreshing. Every family wants the other family to be successful. And so there's not a competitive piece about we own more of this company than you, and we think we know what's best. Usually, you know, when you club up with other families, there's one family may own more and they may know the industry better. And so you're relying upon their expertise, and whether it be logistics or whatever the case may be. And so there's a real alignment in interests because everybody has a long-term perspective. They don't have to sell after 5 or 6 years. So the clubbing with other family works out really well. Now, there's situations where you invest with another private equity firm, and you know that when you're putting this capital in, that it's going to be a short fuse. That's a little bit more challenging in terms of, okay, we want to hold this for another 2 years because we think there's more value to be created as opposed to selling now and getting a lower multiple and then returning the capital. So it gets a little bit, the nuances between 5 and 10 years are a little bit more challenging. What's the other thing I wanted to say? I can't remember. But for the most part, the alignment on the family office side is wonderful. It's one of the reasons I do what I do, because there's just such a collegial feeling, and we all have the same, we all want to hold the assets forever, which is such a wonderful feeling. It's such a different mentality. And that's been such a change for me to get used to as I've made the shift, because the mindset on Wall Street is so transaction oriented and return generated. And what did you do this year? As opposed to how are we going to create value over this for the long term? Oh, I know, in terms of the allocation of capital, for the most part, these businesses are not highly leveraged. And so your hope is that you're going to generate cash flows and pay dividends back. You're going to reinvest to grow the business. Of course you do, because your ultimate goal is to create longer term value by reinvesting back in the business. But if there's no use for the capital, it will pay back to the
Just to add on what Beth said, in terms of negotiating the documents up front, you always want to negotiate in outs, right? If it's not working well, and what will trigger those outs, whether or not it's a Texas shootout, and when can that Texas shootout be implemented, right? So one just negotiated, it was after a certain period that was defined as a stabilization period. There was, I think it was 3 years was the earliest time that could occur, unless there was a major decision dispute. So remember when I talked about earlier about those issues where either the minority or majority on a particular deal has those special input rights. You can trigger buyouts on those as well. And then is it a Texas shootout? Is it the other side has to buy me out if they don't agree with me? Those are all negotiated up front. And again, I highly recommend that those all be negotiated up front, because if they're not, then it is a complete disaster. But at least going into it, you know how to exit if you negotiate it up front.
Sounds good. We have 5 minutes, so a couple zingers out there.
Question.
That's always good.
With the supply chain challenges and employment challenges, are you seeing changes to supply chain, dual sourcing, consulting firms around the world that are focused on supply chains, recommending other jurisdictions besides China? For instance, I'm seeing Thailand being pretty competitive, Mexico, places like that. Are you seeing that as part of strategies and manufacturing and supply chain businesses that you're?
Maybe I can just jump in for the folks online. The question was related to supply chain management and strategy, and if we're seeing any different strategies imposed or tried in this marketplace.
Yeah, I think I'm at least somewhat qualified to answer. Having just run a supply chain business for the last 3 years, we had hundreds of clients sourcing from all over the place. We had an office in Shanghai, a wholly owned entity there, and so yes, it is shifting. I don't think it's going to shift as dramatically as people think, right? I mean, so despite the trade war, they just announced we have our deepest trade deficit in history just yesterday, right? So I don't think there's not gonna be some tremendous wave of like reshoring back to the US or anything like that. I think there will be pockets of that type of stuff, without a doubt. General Motors just announced this new plant in Michigan for EVs and battery production. So there will be some of that. Our clients, though, by and large, really struggled to find other places in Southeast Asia to source things from. It's not impossible, and people do it. But I think what people don't really wrap their mind around is how much infrastructure it takes. And Shanghai is just an incredible place. And if you've ever been there, the ports, the infrastructure, and really that goes for a lot of coastal China. And so you go into Thailand or you go into Vietnam or some of these other places, Cambodia, where people are trying to source things, and it's just exponentially more difficult to get your goods around and transported and sort of out of those ports. And so you'll see it in pockets. I think Latin America's really picking up too. We had some folks trying to migrate pieces of their supply chain there, but from our vantage point, at least, looking at our hundreds of customers, it's still China. I mean, it really is. They're the world manufacturer, and despite the geopolitical stuff that's going on, it's going to be really, really difficult to unseat them as sort of that primary provider.
Very good. I'll take one last question if we have one. We're coming up against the hour here. I want to make sure if anybody has one, we get it in. Well, if not, I guess what I would like to do is on behalf of FEI, I'd like to thank Nathan, Sima, Beth, and Jodi, got it right, Jodi, for being with us today and experiencing a very wonderful 1 hour, which I hope to expand to an hour and a half to an hour and a half next year. Plug. So anyway, thank you very much, and let's give them a hand.
Thank you folks for your participation. I will now end the webinar.
No, it is supposed to be, you're right.